Right now, as you're watching this, you're probably losing about $847. Not tomorrow. Not next month. Today. And you have no idea it's happening. Here's what's really crazy. You think you're winning. You check your credit score app, see that beautiful 750, maybe even 800, and feel like you've mastered the game. You pay your bills on time. You keep your utilization low. You're doing everything right. But what if I told you that your excellent credit score is actually a ticket to the most expensive club in America? A club where you get the privilege of paying hundreds of thousands of dollars more than the people who figured out the real game? Stick with me for the next few minutes, because what you're about to learn will fundamentally change how you think about money, debt, and wealth in America. And it starts with a lie we've all been told. But before we expose this system, hit that subscribe button. This channel breaks down the money games most people never see, and trust me, you don't want to miss what's coming next. Let's start with a question. What is a credit score? If you said, a measure of how trustworthy I am with money, you're not alone. That's what 90% of Americans believe. And that's exactly what the system wants you to think. But here's the truth that nobody tells you. Your credit score isn't a measure of how good you are with money. It's a measure of how profitable you are to lenders. Read that again. How profitable you are to them. Think about it. Do you know who has terrible credit scores? People who pay cash for everything. People who've never borrowed a dime. People who are actually amazing with money. And do you know who has excellent credit scores? People who've been in debt for decades. People who carry balances. People who make minimum payments like clockwork. The system literally rewards you for being in debt and punishes you for avoiding it. But here's where it gets really twisted. Once you understand this, you'll see the trap. The credit score system isn't designed to help you build wealth. It's designed to make you the perfect long-term customer. And most of us walk right into it, smiling, thinking we're playing the game smart. Let me show you exactly how this costs you millions. Let's talk about Sarah. She's 28, makes $75,000 a year, and has a credit score of 680. Not bad, right? It's good, according to the official ranges. Sarah wants to buy a house. She finds one for $400,000. With her 680 score, she qualifies for a 30-year mortgage at 7.2% interest. Her monthly payment? About $2,700. Over 30 years, she'll pay roughly $972,000 total. That's $572,000 in interest alone. Now meet Jessica. Same age, same income, same house. But Jessica has a credit score of 780. She gets a 6.3% interest rate. Her monthly payment? About $2,480. Over 30 years, she'll pay roughly $893,000 total. That's $493,000 in interest. Do the math with me. Sarah pays $79,000 more than Jessica for the exact same house. Same bricks. Same roof. Same kitchen. $79,000. But wait, it gets worse. Because that $220 difference in monthly payments? If Jessica invested that instead of paying it to the bank at a modest 7% return over 30 years, that grows to an additional $268,000. So the real cost to Sarah isn't $79,000. It's closer to $347,000 in lost wealth. For the same house. Because of a number that most people don't even understand. And here's the kicker. Both Sarah and Jessica are playing the game. They both have good credit. Sarah just doesn't have excellent credit. She's still following the rules. She's still doing what she's told. She's just losing $350,000 for it. But mortgages are just the beginning. Let's talk about credit cards because this is where the psychology gets really dark. You've probably heard the advice. Get a credit card to build credit. Keep your utilization under 30%. Pay it off every month. Sounds responsible, right? And if you actually do pay it off every month, you might think you're beating the system. But here's what the data shows. 45% of Americans carry a credit card balance month to month. The average balance? About $6,500. The average interest rate? 24.37%. Yes, you heard that right. 24.37%. Let me put that in perspective. If you carry a $6,500 balance and make only minimum payments of about $195 a month, it will take you 17 years to pay it off. And you'll pay $8,124 in interest. You'll pay more in interest than the original amount you borrowed. But that's not even the clever part. The clever part is how they get you there. Credit card companies don't make their real money from annual fees. They make it from interest and from the psychological game they've perfected over 50 years. They give you a $10,000 limit. They tell you to keep utilization under 30%, so you think $3,000 is safe. They make the minimum payment so low that it feels manageable. $25? $50? Sure, you can handle that. What they don't show you is the counter in the background calculating how much of your life you're trading for that dinner you put on the card 3 years ago. And here's the really insidious part. The entire time you're in this trap, your credit score might actually be going up. Because you're making payments. You're being profitable. You're the perfect customer. Let me tell you about Marcus. Marcus is 35, works in IT, makes decent money. About 6 years ago, he had 3 credit cards with a combined balance of $18,000. The interest rates ranged from 19% to 26%. Marcus did what he thought was smart. He made his minimum payments religiously. Never missed one. His credit score actually improved over those 6 years, going from 640 to 720. He felt proud. He was being responsible, right? But here's what actually happened. Over those 6 years, Marcus paid roughly $31,000 toward those credit cards. $31,000. And you know how much his balance went down? About $7,000. He still owed $11,000. Where did the other $24,000 go? Interest. Pure interest. Money that disappeared into the system while his credit score went up, and he felt like he was doing the right thing. Marcus wasn't irresponsible. He wasn't reckless. He was playing exactly by the rules. And the rules are designed to drain him slowly enough that he doesn't notice he's being drained. Let's keep going because the rabbit hole gets deeper. Auto loans. The average new car loan in America is now $40,000 at about 7.8% interest for 68 months. Yes, 68 months. We've normalized being in debt for almost 6 years for a depreciating asset. On that loan, you'll pay about $8,400 in interest. But here's what most people don't consider. That car loses about 20% of its value the moment you drive it off the lot. So you're immediately underwater. You owe more than it's worth. And for the next 5 to 6 years, you're making payments on something that's dropping in value while paying interest on money you borrowed to buy it. It's literally the worst financial move you can make, mathematically speaking. You're paying interest to own a depreciating asset. It's the exact opposite of how wealth is built. But we do it because the system makes it feel normal. The commercials show happy families. The dealership makes the monthly payment seem affordable. They don't show you the total cost. They don't show you what that $500 a month could become if you invested it for 30 years instead. That $500 a month at 8% for 30 years? That's $745,000. You're trading $750,000 in future wealth for a car that'll be worth $3,000 in 10 years. And your credit score? It might go up from taking out the loan. Because you're playing the game. You're generating profit for the system. Now here's where it gets even more twisted. Let's talk about the actual cycle that most Americans find themselves in. You get your first credit card in college. Maybe it's got a $500 limit. You use it responsibly at first. Then the limit increases to $2,000, then $5,000. The offers keep coming. Pre-approved. 0% for 12 months. So you use it. Maybe for an emergency at first. Then for conveniences. Then for things you want but don't need. The balance grows. The promotional rate expires. Now you're at 22% interest. But the minimum payment is only $85, so it's manageable. Then you need a car. You finance it because everyone does. That's $400 a month. Then you buy a house because renting is throwing money away. That's another $2,000 a month. Now you're paying $2,500 a month just in debt payments. And that's before utilities, food, insurance, everything else. Your credit score? It's pretty good. Maybe 720. You're making all your payments. The system loves you. But you know what you don't have? Savings. Investments. Any real wealth. You're on the treadmill. And the treadmill is designed to keep you running in place while your most productive earning years tick away. The credit score system was created in 1989 by Fair Isaac Corporation, hence FICO score. Before that, lending was more subjective and often discriminatory. The FICO score was actually an improvement in creating standardization. But here's what happened. Once the system existed, entire industries built themselves around it. Credit bureaus, monitoring services, repair companies. Billions of dollars in industries that exist solely because of this three-digit number. And then financial institutions realize something powerful. If people obsess over their score, they'll make decisions based on raising that score, not on building actual wealth. Let me give you an example. Paying off a loan completely can actually drop your credit score temporarily because you've closed an account and reduced your credit mix. So the system literally discourages you from getting out of debt. Think about that. The behavior that's best for your financial health, being debt-free, is penalized by a system that claims to measure your financial responsibility. It's not a bug. It's a feature. The system wants you to have some debt all the time, forever. Not so much that you default, but enough that you're constantly paying interest. Enough that you're profitable. There's actually a term for this in the credit card industry. They call ideal customers revolvers. People who revolve a balance month to month. People who pay enough to avoid default but never enough to get out of debt. So here's the million-dollar question. Literally, over your lifetime, between mortgages, auto loans, credit cards, student loans, and every other form of consumer debt, how much do you think the average American pays in interest? The estimates vary, but financial analysts put it somewhere between $600,000 and $1.2 million over a lifetime. Let that sink in. You could pay over $1 million just for the privilege of borrowing money. Now imagine if that money stayed in your pocket instead. If you invested even half of what you'd pay in interest, you could retire with multiple millions in the bank. But here's the psychological trap. The payments are spread out. $200 here, $500 there, $2,000 for the mortgage. It doesn't feel like $1 million. It feels like monthly payments. Manageable, normal, just part of life. And that's exactly how the system works. Break the pain into small enough pieces, spread it over enough time, and people don't realize they're being robbed. It's like the old metaphor about boiling a frog. Put a frog in boiling water, it'll jump out. Put it in cold water and slowly turn up the heat, and it'll stay until it's cooked. That's us. We're the frog. And the water's been getting hotter for 35 years. Now let me tell you something that'll really bake your noodle. Wealthy people don't play this game the same way you do. Yes, they use credit. Yes, they have credit scores. But they use debt completely differently. When a wealthy person takes on debt, it's usually for something that produces income or appreciates in value. Investment properties. Business expansion. Assets that generate cash flow. When the average person takes on debt, it's for consumption. Cars, clothes, vacations, dinners. Things that disappear or lose value. Wealthy people use other people's money to make money. Average people use other people's money to buy stuff. And here's the really unfair part. Wealthy people often get better interest rates despite borrowing more money. Because they have assets. They have collateral. They have relationships with private bankers. The system is literally designed to give the best deals to the people who need them least and the worst deals to the people who can afford them least. A millionaire might get a 4% rate on $1 million loan for an investment property. A working-class person might get a 24% rate on a $5,000 credit card. The rich get richer not just because they have more money, but because money itself costs them less. And this brings us to the deepest part of the trap, the psychology. The credit score system has successfully convinced millions of people that a high score is the goal. It's become a status symbol. People brag about their 800 scores the way they brag about their cars. But a high credit score isn't wealth. It's not freedom. It's not financial security. It's proof that you've successfully made yourself profitable to lenders. The system has gamified debt. It's turned borrowing money into an achievement you can track, optimize, and feel proud of. We check our scores on apps. We get excited when they go up. We stress when they go down. We make financial decisions based on what will help our score, not what will help our wealth. It's genius, really. Create a metric that measures profitability to lenders, convince people it measures their financial health, and watch as millions of people optimize their lives around making banks richer. I want to share something that happened to a friend of mine, David. He's a software engineer, makes about $120,000 a year. Smart, disciplined guy. David decided to become debt-free. He had a mortgage, a car payment, and about $15,000 in credit card debt. Total debt around $280,000. Over 4 years, he paid off the credit cards and the car. He was making triple payments on his mortgage. His debt dropped to $180,000. His credit score? It dropped from 780 to 710. Why? Because he closed the credit card accounts after paying them off. Because he paid off the car loan. Because his mortgage was his only remaining account. He was doing the absolute best thing for his financial future, and the system penalized him for it. That's when it clicked for him. The system isn't measuring financial health. It's measuring participation in the debt economy. So what's the alternative? Completely avoiding the credit system in modern America is nearly impossible unless you're already wealthy. But what you can do is change your relationship with it. First, understand that your credit score is a tool, not a goal. Use it when necessary, but don't optimize your life around it. Second, minimize the damage. If you need to take on debt, take on as little as possible for as short as possible. A 15-year mortgage costs you dramatically less than a 30-year. Let me break this down. On a $300,000 mortgage at 6.5% interest, the difference between a 30-year and 15-year term is staggering. 30-year mortgage, monthly payment of about $1,896. Total interest, $382,632. 15-year mortgage, monthly payment of about $2,613. Total interest, $170,340. The monthly payment is $717 higher on the 15-year. But you save $212,292 in interest. $212,000. Most people see that $717 difference and think they can't afford it. So they take the 30-year loan and spend that extra $717 on other things. Streaming services, eating out, whatever. They're not unable to afford the 15-year payment. They're choosing to spend that money elsewhere. And that choice costs them over $200,000. Third, prioritize building actual assets over maintaining a high credit score. Your net worth is what matters, not your FICO score. Would you rather have a 750 credit score and a net worth of $50,000, or a 680 credit score and a net worth of $500,000? The answer is obvious. But most people obsess over the score and ignore the net worth. Fourth, understand the math. Before taking on any debt, calculate the total cost, not just the monthly payment. Dealerships and retailers play the monthly payment game. Only $49 a month. They hide the total cost because it's offensive. Nobody wants to pay $4,272 for a $2,000 couch. But $89 a month sounds reasonable. Do the math. Always do the math. Fifth, break the cycle. Even if you can't completely avoid the system, you can choose not to pass the same mindset to your kids. Teach them that debt isn't normal, that the goal isn't a high credit score, it's financial independence. Because the next generation faces even worse odds. Student loans are higher. Housing is less affordable. The cost of living keeps rising faster than wages. If we don't teach them to see the system for what it is, they'll be even more trapped. Here's the bigger picture. The credit score system is a symptom of a much larger problem. We live in a society built on consumption and debt. The entire economy depends on people borrowing money to buy things they can't afford. If everyone suddenly decided to only buy what they could pay cash for, the economy would collapse. Auto sales would tank. Housing would freeze. Consumer spending would crater. The system needs you to be in debt. It's not a side effect. It's the foundation. 70% of the US economy is consumer spending, and a massive portion of that is financed. The economy literally runs on your willingness to go into debt. Your credit score is the tool that makes it all feel scientific, objective, and fair. It gives the illusion that the game is based on merit when really it's based on profitability. There's a reason financial literacy isn't taught in schools. An educated consumer is a less profitable consumer. So here's your wake-up call. Every time you check your credit score and feel proud of that high number, remember what it actually represents. It represents how good you are at making other people rich. Every time you finance something because the payment fits your budget, remember what you're trading. You're trading your future wealth for present consumption. The credit score game isn't designed for you to win. It's designed for you to play forever, and the only way to win is to understand that and minimize your participation. So here's my challenge. The next time you're about to finance something, about to take on debt, about to make a decision based on your credit score, stop and ask yourself one question. Am I doing this to build wealth, or am I doing this to play the game? Because the difference between those two things is, quite literally, worth millions. The system is counting on you to never ask that question. But now you know. You know what the credit score actually measures. You know how much it costs to play. You know the game is rigged. What you do with that knowledge is up to you. If this opened your eyes, hit that subscribe button and turn on notifications. We break down the financial games most people never see, and there's a lot more where this came from. Thanks for watching. Now go look at your credit score differently.